how do you really optimize ILITs and the policy here with how do you pay for the policy premium? And the answer is it really depends on the type of policy you have. Maybe Peter, let's start with what kind of just how do policies compare between term and permanent life insurance?
Yeah, so the big, a few differences, but a big difference in terms of funding the premiums is so term policies tend to have pretty small premiums relatively, and so depending on the size of the death benefit, depending on your age and health and whatnot, you might have a term policy where the annual premiums are like $10,000, $20,000 a year. On the other hand, there's some permanent policies, particularly what's called PPLI, which stands for Permanent Placement Life Insurance, which is a popular type of life insurance for people who are looking to build up a lot of have a large investment component in their life insurance policy. It's used a lot for people who are doing estate tax planning inside of ILITs. Those policies tend to have enormous premiums, but it's usually only like 5 years of premiums, but it might be like $1 million a year for 5 years. And so for those, you need a pretty serious source of liquidity. It's not just little checks each year. And so there's sort of two big picture ways of funding an ILIT with the money it needs to pay premiums. And so one big picture idea is you just say, that the premiums are $1 million over the course of how many years. I'm just going to contribute, around $1 million up front. And then the trust will just, pay the premiums from that liquidity each year. And then you can always add more cash in the future if it needs it. And so that's sort of like the big picture, sort of idea one. So either you fund it with a bunch of cash or securities up front, or you fund it with maybe real estate or some kind of income producing asset. And then you say, I'm going to pay the premiums from the rental income or something like that.
And a key piece to call out here, right? This is going to either use up likely a large chunk of your lifetime gift exemption or potentially cause gift taxes if you've already used your lifetime gift exemption.
Yeah. So in most cases, people setting up ILITs haven't used, or like ILITs that are using that require significant premiums. Most of these people haven't used their lifetime exemptions, and so it'll just use up a portion of their $14 million exemption.
Yeah, exactly. The typical is that you haven't used it up, but you will use it up, which means that you have less remaining.
Yes. So the other strategy is to pay the premiums every year, to make contributions to the trust every year. So if you know that the premiums are due in July, every May or June, you make contributions to the trust of an amount that's sort of close to what the premium is going to be. And then the trust just uses that amount on an ongoing basis to pay those premiums. This is more common when the premiums are lower. And part of the reason for that is that most ILITs are set up so that they're what's called Crummy trusts, which means they're trusts where you can make annual exclusion gifts.
And how much is the annual? What is the annual exclusion?
Yeah, so you can gift an individual $19,000 a year without using any of your $14 million lifetime exemption amount. If you have 2 kids, you can gift each of them $19,000 a year. So if you're married with 2 kids, you can gift them $76,000 a year, 19,000 times 2 times 2. But what you can do is instead of giving the money to the kids directly, you can set up a trust called a Crummy Trust that gives the kids the right, at least in theory, to withdraw that amount. And basically by giving them those withdrawal rights through the trust, you make the trust eligible for the annual exclusion. So the basic idea is, let's say you have a term policy and you create an ILIT. It's for the benefit of your 2 kids. You put the term policy inside of it. The annual premiums are $25,000 a year. You can just make $25,000 gifts to the trust each year. And those can be annual exclusion gifts, so they don't use any of your lifetime exemption amount. And the trust will have enough money to pay the premiums itself.
Yeah. How much could you, with this annual exclusion, fund your life insurance policy with?
Sorry, how many kids did you say?
3 kids, 2 grandkids.
Yeah,
Make it complicated.
So it would be 5 beneficiaries. If you're married, you double up, so that's 10. Each of you and your spouse get 5, and so that's 10 annual exclusions. And so, it's $19,000 times 10, which is 190,000.
Yeah. And so this is where is, kind of on this slide, typically annual exclusion gifts are used to fund term policies because it's smaller amounts versus in permanent, as Peter mentioned, it's a large bulk up front. But this is where if you have a lot of kids, you're married, $190,000 per year without using your lifetime gift exemption can add up to be pretty significant. And you can actually potentially build up enough to actually fund a permanent, but that's one dependent on having a lot of beneficiaries, having a spouse to be able to make those numbers work.
Yeah.
But in most cases, you can fund a term with these annual exclusion gifts, protect your lifetime gift exemption. With a permanent, it'll often take pre-funding the trust with larger assets, but there are times where you can make those annual exclusion gifts work, as we're kind of mentioning there. Now, there's really kind of like, there's one key thing that you really shouldn't do to how to pay for these ILIT, the life insurance premiums that are inside of an ILIT. Do you want to kind of explain why you shouldn't pay them yourself?
Yeah. So a couple of reasons. What happens pretty often, I would say, is that people set up the ILIT correctly, but then instead of having the trust pay the premiums, they just write a check to, Lincoln or whatever the insurance company is themselves each year. And so that they're directly paying the premiums. And so a couple issues. One, that's going to be, those premium payments are going to be taxable gifts. So they're going to use a portion of your lifetime exemption. Whereas, you could have used annual exclusion gifts probably instead. And so it's not super efficient from a gift and estate tax perspective. And the other thing is just you want to create as much space as possible between the grantor of the trust and the trust, so that the IRS is going to want to try to argue that you never really transfer the policies to the trust.
Yeah, it's in name only.
Effectively owned by you, and so paying the premiums themselves probably isn't enough to cause estate tax issues. But I think that if you're paying the premiums and doing other stuff, it could sort of paint a picture of you never really, like, the trust never really owned the policy. It was really owned by you. And so you want to sort of create as much separation between you and the ILIT as you can.
Yeah. There's a couple of questions. I'll start with there's one of, and Michael also has a similar question of what if there's insurability things. Essentially is if there's a problem getting life insurance, it's an entirely separate thing of like, can you get that? The ILIT isn't going to make sense unless you can get life insurance, right? There's other structures you can use for estate taxes, like, it's same structure, but called Crummy trust, etc. But really the ILIT only makes sense if you can get life insurance. And in this question, is there a typical kind of age, Peter? You may not have the answer.
I would say usually if people are under 60 and they're worried about estate tax, they can find a decent policy. So like term policies, usually a 60-year-old wouldn't be getting a term policy, but some of these other types of policies like PPLI can still make sense for people like in their 50s, definitely 40s, but even people in their 50s, they can still make sense because they're less focused on death benefit and more focused on the investment components. And so the death benefit piece is actually relatively small. And so even if the death benefit would be relatively expensive, it actually wouldn't be that bad in sort of the grand scheme of things.
Yep. So that's a piece here. There's another question from John before we get into this case study of if rental real estate is covered. So essentially the income option one here, you're pre-funding this with the real estate that generates income to pay for the premiums. Is there a 1041 step up, and who pays the accumulated depreciation when the real estate is sold?
So the trust is outside of the trust is outside of your estate. And so if you died with the trust owning the real estate, there's no basis step up. There's a couple of things here though. Anytime, so that the ILIT would be what's called a grantor trust, which is ignored for income tax purposes, although it doesn't qualify for the basis step up. It's ignored for income tax purposes. And so one thing that you can do is, let's say you transfer real estate to an ILIT, 10 years ago, and now it's really appreciated. And you think, what if I die? I'm not going to get basis step up on the real estate. What you can do is you can swap it out for a different asset. Essentially, you buy back the real estate from the trust in return for something of equal value. And so what you would do is you get the real estate appraised. It's appraised for $5 million. You pay the trust $5 million for the real estate. the trust gives you the real estate back. And so now the real estate, which is appreciated, is back in your name. And so if you died, you get a basis step up. And the trust now has $5 million of cash or stock or whatever it is that has a higher basis. The other thing is I just use real estate as an example. I have seen people use real estate in ILITs. It's not super common. There's other income producing assets though. You could have some kind of like private credit or something that's throwing off income, some other type of investment that's throwing off consistent income.